Welcome to StockMarketFunding.com. There is a rule about selling short, the uptick rule, and the SEC has passed it. So if a stock drops 10% in a day, then you're not going to be able to sell short the stock. And the SEC asked for public comment on April on several alternative approaches to restraining short selling. And a bipartisan group of senators have pushed the agency to act or face legislation. Okay? The agency got more than 4,300 comments on the issue. And what is needed, they said, is a restoration of the Depression-era uptick rule, a permanent constraint allowing short sellers to come in only at a price above the highest current bid for a stock. The SEC abolished the uptick rule in July of 2007 when the stock market was near its peak. The SEC staff estimates that only 1.3% of stocks hit the 10% decline threshold during the normal trading days without wild market swings. Investor confidence was shaken as the market plunged amid the financial crisis in 2008. And proponents of restoring the restraints said that they were needed to prevent abusive trading. They maintained that the absence of the restraints fanned market volatility, prompting hedge funds and other aggressive investors to target weak companies with an avalanche of short selling. Now, basically what they're going to do is put a circuit breaker. The SEC said that the rule strikes a balance between two objectives: preventing a short seller from driving the price of a gutted stock even lower, and preserving the benefits to investors from legitimate short selling, such as pumping cash into the market. The balance comes, the agency said, because the circuit breaker restrictions are temporary and are applied to a specific trading session, to contrast to the other alternatives, such as the uptick rule that would institute permanent constraints. The reason this rule makes sense is because it recognizes that short selling can potentially have both a beneficial and a harmful impact on the market, depending on the circumstances, the SEC Chairman Mary Shapiro said. Well, my view here about it is, if a stock is weak and it's going to go down 10% in a day, it should be sold short. And that means that companies like the banking sector, like AIG, Citigroup, Wells Fargo, Bank of America, if the stocks, they did the wrong things, their stock prices fall, people sell short, they make money, and guess what? Merrill Lynch should have been out of business instead of being bought. Bear Stearns is out of business, Lehman's is out of business, and all of them that fell, rightfully, in my opinion, they deserve. But guess what? They're going to try to make sure that they restore this uptick rule. It was a 5-0 vote Wednesday. The SEC commissioner adopted a statement laying the agency's support for global accounting standards in its belief that they would benefit U.S. investors. Well, you know what, people? I'm just going to leave it like this. There's going to be a lot more on the subject. We'll be covering it on our radio show. All you got to do is go to StockMarketFunding.com, sign up. We'll cover it more in depth. All I can tell you is that if there wasn't short selling, and they're talking about putting a breaker in a stock not going down more than 10% in a day. That's not what this business is about. If a stock misses its earnings, or a publicly traded company has done something like Enron did, they deserve to go to zero. And let me leave it at that.